Good morning. It's earnings time, and the bells are ringing behind me. I don't know why. So today we're going to talk about all the earnings, the big earnings that are out. So Tesla came out after the close last night. Microsoft, Meta, UPS, lots to talk about there. And tonight after the close, Apple, we're going to break some things down, show a few strategies potentially, and try to get into the bits and pieces of the Apple earnings report after the bell. I was waiting for the
happy birthday to you. Happy birthday to you. Happy birthday, dear Lex Luthor. Happy birthday to you.
Thank you, guys. Thank you. We don't count birthdays anymore, but it is one today for sure. Thanks very much. I appreciate it. How are you guys? Good?
Doing great, Lex. How you doing?
I'm doing great. You know, this is a good day for me. So heading downtown, Mark, as you can imagine, to the big Chicago city, and I'm sure I got my wine lined up and big dinner tonight. I don't even know where I'm going. It's a surprise. So,
ooh, I can't wait to hear.
Yeah, I know.
You know what you're drinking at least?
I do not. No, I know nothing.
Who's
other than
taking you?
I'm supposed to wear a sport coat. That's it.
Who's taking you?
My family.
Oh,
Go figure, right? Yeah,
right.
I'm paying, of course, but they're taking.
Wait, are you appreciated?
I'm appreciated. Unbelievable. All right. Well, what do you guys say we take a little peek here? We're talking earnings, right? So let's go over the ones that came out last night. Tesla looks like that's up a little bit, right? Jason, we were talking about this earlier. Where is that? So Tesla had
I think this is just over 400. It's up a little bit.
It's up a little bit. Yeah, so it's up 1.5%, up about $6-ish, $5, whatever. So that's kind of nothing much going on. I do have something to show on that spread that I did. We can talk about that in a sec. Microsoft got hammered, right? That's down $20 on earnings, which is a big move. That's about 5%. And then Meta, how are we doing in Meta? Anyone know?
Meta's up.
Oh my God, looks great. Yeah,
Meta's doing great.
So Meta is up 4.3%, $30. So it's a $700 stock, $30. That's great. So they obviously beat. So those look pretty interesting. The one pretty bad one, I think, though, is UPS. Jason and I were talking about this pre-show. Yeah. UPS is down 17.5% ish. Right. Yeah. So that's $20 and it's $113 stock. Yeah. And you said that you knew this was going to happen, Jason.
Oh yeah, I mean,
we didn't know. You don't know
I was going to happen.
Yeah, I know you knew, like you know what day it is.
I have quite a few friends that work in the warehouses, and you know, like they do like all the automation and the till trays and stuff like that.
Yeah,
and they said that their peak season in December was pretty light, so. I was like, oh.
All right, so let's ask Mark.
Horseshoe hates United Parcel Service.
Yeah, exactly. Is that insider information? Oh my God.
No, they're Teamsters.
No, but you know what? They're not giving you non-public information, I don't think, right?
That's true. They're not. That's true.
So you know, they could have given you that information and the opposite could have happened had you acted on it.
That happens actually kind of frequently. That's just why I don't usually play like big plays, because they only see like their own little corner. They don't see, you know, they're not in Kentucky.
Yeah.
So
all right. Yeah. So
why are Teamsters protected? So if you're a Teamster, you can give out inside information?
Oh no, it's just saying, I mean, only they're not like they're not executives, right? Like
right, but anyone I think, you know, that's privy to material, non-public information is subject, you know, anyone can get it. It's not just executives.
Right. Yeah. But like if you I mean, I don't know, but if you work for a company, like a publicly traded company, you kind of have an inkling of, you know, in my little corner, we're doing poorly, so I will short, or in my little corner, we're doing well, so I'll long into earnings. Do you get in trouble for that just because you work there?
I don't think you can trade your own stock. Is my
yeah, and like I think you'd get pretty quickly flagged by doing that, especially with
you
the
can't
timing.
do that. That's a no. I'm almost positive.
Yeah. Well,
Um,
he doesn't have insider info because he's wrong a lot too. So
yeah, right. I get it. All right. So let me ask a question. What do you do with these earnings reports? So, Mark, I'll go to you first because you're Mr. Market Maker, like I was. I would come straight out and say I didn't really like earnings so much as a market maker. I was given positions all the time, so inevitably, I'm either long a lot of stuff or short a lot of stuff. Probably mostly short, if I remember correctly. Especially that front month, premium, which is always much higher. So what's going on there? What do we like to do with this kind of stuff? Any ideas? I have one, but I'll let you go first if you have some ideas.
I would say that over time, earnings have gotten significantly better priced.
Sure.
So like you say, originally everyone wants to buy them because they think stocks are going to move. Then there was a huge trend of wanting to sell them. And I think overall participants in general have gotten much better at pricing expected moves, contextualizing that move to the volatility environment.
Yep.
There are a lot of tools that, dealers can have at their disposal to efficiently trade these earnings. What they really like is the volume, though. Like at the end of the day, having people that have an opinion and want to take their markets is exactly what they're there for. So whether they're long or short or whatever their position ends up being, the explosion of volume that happens around earnings is really the thing that market makers are there for.
Right. 100%. So hang on one second. I'm looking at one thing here. Sorry. I'm looking at Tesla. Okay, got it. Yeah. So, but as a retail person, and these are the most of the folks we talk to, right? Any kind of sound advice, okay, not investment advice, blah blah blah, the disclaimer, but ideas and strategies to trade earnings, or is the best advice stay away? I mean, potentially that could be the best trade is not to make any trade at all. I happen to like trading them, but do you guys have any thoughts on how to trade earnings as a retail person? How to set up a trade?
I got two comments. The first is Mark is absolutely right in that earnings have been so much better priced recently.
Yep.
And it used to be if you're an option trader, you can get an edge. But with few exceptions, Tesla being one of the exceptions, and this today being showing that it's maybe not a great exception, but most of the time, like especially I'll ding Matt Amberson's ORATs, is you see the expected move and the move that happens is the expected move, like trying to kill both longs and short premium kind of people.
Yeah.
And then as far as like trading goes, like if you're a retail trader, it's either stay away or do option strategies that keep your risk extraordinarily low.
Yeah. Yeah, I agree with that. So
like butterflies or, something, that keeps it low based on your analysis of the report.
Yep. Perfect. So let's go to the screen real quick, Luis, if we can. Okay, so this is trading platform Tradier Pro. I've got a position on. Let's talk about Tesla first, okay? Mm-hmm. So I'll give you the breakdown because I just remembered and I looked at it, and you guys might not have. So yesterday, this stock is only up about $3.50, right? So yesterday, when I looked at this, and it could have been 2 days ago, I was looking at the 390 strike. Okay,
that was down 65 cents now.
Yeah. So when I looked at it, implied volatility in that front month is always astronomical in the earnings month. And then they fan down in months after. So all these months start going lower and lower and lower, right? So there's a big gap of implied volatility between the front month earnings month and the next one. Okay. And we know why that is. It's the binary move, the jump risk, all that kind of stuff. So one of the things I like to do is I like to do that double time spread. So I like to sell the front month and buy the back month, or the second month, sorry. The reason I like to do that is I take advantage of a really high volatility. I use the calendar, the time spread, because I don't like diagonals and having strike risk on top of it for gigantic moves that kill me, right? So that's why I like the time spread part of it. Now, I know we argued about this in the past. I did this Tesla one, and you can see the 100 lot here, and I'll go down. There's the 100 lot there. Look how far away from the strike is. This one was a big miss in terms of the expected move. It was a $30 move, I think. $25, $30 move. Okay. Didn't come anywhere close to that. So I missed on this one by not getting the move toward one of my short strikes. Didn't work. Okay. And I'm going to show you some details now. If you look at this, I pulled this out. I did this for $6.35. I paid $6.35 for the double calendar. I bought the put calendar, bought the call calendar. $6.35 was my debit. I missed. Didn't work. Look at where it's trading. $6.74. So I'm up a little bit of money on that trade with a miss. With a miss. So not horrible. And that's why I like these so much. I get to buy some time on these. You know, if I do hit, it goes toward a strike, I can take off one side of this double calendar for maybe a big enough profit for the whole thing. And then I'll just leave the opposite side on for days, right? And maybe play the lotto ticket game. Does that all make sense? I mean, I'm not sure you're saying you agree with it, but my explanation makes sense. Right?
Yes, that makes sense.
Okay. So, you know, that's what I like to do in those sort of things. And this was a miss, right? If you look at Apple, which is going to be tonight, let's go to Apple. Okay. I have this one set up. And I didn't say, but the way I like to come up with expected, there's a fancy formula that's very easy to use. The fancier or the easier thing to do is take the at the money straddle or the straddle at the money, add the midpoint of the column put together, same strike of that straddle, right? And it comes up to a number. So let's look at this one. So let's call it 460 and 545, right? So 460 plus 545 is $10-ish, 10.05. Let's call it 10. Don't have to be perfect here, dropping grenades. Just get close. So I went down $10 to 230. I'm going up $10 to 250. $10 each way. That's where I place my shorts, roughly. You can go up a little bit more, or, you know, if you want to be not as aggressive, go down a little bit. That's what I like to do. And then I go to the next month, same thing on the long. So I've got this double calendar spread on for 160. It's now 160. Let's put it down there at 160. Okay. So that's the most I can lose is 160, right? But don't forget, when the earnings come out, okay, it's going to be expiring. The shorts are going to expire tomorrow. You know, once it comes out, they're going to get crushed. Stock's going to move, and then these are going to go down too, right? But I have 8 days with this one. So these are going to lose all our premium. I got 8 days left here. So that's why I like that spread. That 8 days gives me some life of having some value to the spread, even if I miss, right? Now, the worst thing is if it goes to 207 or, you know, 300, that's going to collapse. That 160 is going to collapse pretty good, right? Mm-hmm. That's where it gets troublesome. Any comments, thoughts? I know you guys like butterflies. We'll talk about that in a second too. Any thoughts on these ideas, you know, critique, yada, yada. Okay, good to talk to you guys.
I was waiting for Mark because I spoke last. But basically what this move is counting on the fact that the market makers have priced in earnings very well.
Correct.
Your Tesla miss, I mean, the way this strategy is, the Tesla miss is like a light miss because you're in the middle of those calendars.
Correct. Yep.
Right. The big miss is Tesla goes up to 480.
Yeah, that's what I said. If it goes way, way up, you do get collapsing for sure.
Yeah, you do.
If you miss on a gigantic move, that's worse than missing on a very small move. 100%.
Yeah.
Right?
Go
ahead. Sorry.
No, the other thing is it is tough to gauge if the implied volatility on your front strike and back strike are distributed well. So a lot of times I see, like, when you do a move like this and the front strike will be this Friday, so it'll be tomorrow, and the back strike will be in 8 days. But that back strike also has elevated IV. If you look, I mean,
correct. I'm glad you brought it up because we're going to talk about that too. Yep.
Yeah.
So you're actually buying Vega, and you're buying high Vega than it normally is because of the way the whole curve of implied volatility across expiration has moved. Mm-hmm. However, one thing to note, and I don't know the formula to this, you know, maybe you or Mark does. I got to look it up. I don't remember it. But when you have a calendar spread and you're buying a volatility, in this case, I'm buying, let's say 42. Okay, I'm pointing to it up here, and we're selling 90 just to make the numbers easy and round. What I'm buying in Vega isn't the average of those two numbers. It's another algorithmic number that is actually lower than 42, believe it or not, because of the difference of these volatilities and the time in between. There's a square root function that computes this. And I'm going to have it for the next show, and I'm going to show it on the screen with this formula. It's a little fancy, but it's great because it tells you that, yeah, you're long Vega, but you're not long the average of these two. You're long, like, I'm making this up. You're long 38 vol instead, right? Actually. So that's why it's that's why I love it, because of the difference in my trades, I'm getting a better Vega play than not. And it still might be high, but when those two kind of rearrange themselves, they're both going lower, but the big one I'm short is going way lower, right? Make sense?
Yeah.
So anywho, now what about the, so what if someone says, well, great, Lex, I don't care because I'm bearish on Apple. I think Apple's going to get hammered. I don't even want to waste money on the upside. Okay, love it. You've got an opinion. All right. What do we do on an opinion? Do we do butterflies? Do we do broken wings so that if he's really right and it gets killed, it's going to run through all the strikes and you still make money? What are your thoughts on the directional retail person who really feels strongly about a big miss one way or the other, or big miss or big beat for that matter?
Yeah. So from a directional standpoint, again, you want to be extremely low risk, because if you're just shorting your Apple, shorting your Apple stock and you're wrong and Apple blows earnings out of the water, you have this you have infinite losses possibilities. You know what I mean?
Yeah.
And it's also the decay in implied volatility is why I like, short gamma moves. And I typically, if I'm not doing like a butterfly that's like way out of the money, I'll do like a condor that may lean in a direction that I like.
Okay.
And condors will be cheap compared to what it normally is because of the earnings. So I'll lean a little bit. I'll do, I won't make it like directly in the middle. Things like that is what I would do, unless, of course, you're expecting them to blow out. Then what I like to do is like a butterfly way out of the money.
Okay.
And
do you pick the short strike around the expected move, or if it's a blowout, you're probably going way beyond the expected?
I go beyond it. Yeah. And if I'm expecting like the expected move kind of thing, I will break a wing to accommodate. Like if I think it'll blow out to the downside, I may even put the short strike just below the expected move and then make a broken wing so that you have a big
you win on a huge move that runs through all the strikes on that broken wing.
Yeah.
Okay, good. Mark, any thoughts on all this stuff?
I think my first thought on directional bias is that if you think you have one, you're probably wrong. And
I'm always wrong. I know that, man. I never have a bias. That's why I do these things, because I have no idea which way it's going.
And thank you for tipping your local market maker with your trading. We appreciate you. But like seriously, I think so. Like on the directional bias, maybe someone has something. Congratulations. But I think I wanted to comment on your initial like sort of neutral structure.
Yep.
And kind of the way I think about that is, you're taking some risk to set yourself up for some opportunities to scalp and manage that trade opportunistically. That you're looking for some swings that you can capture profits, like you were talking about, if it goes to one leg or the other, keeping one on, taking it off. Like at the end of the day, all the risks you're talking about in terms of your Vega risk, in terms of your gap risk, like those are all risks that you're accepting to have this opportunity to scalp in the middle. And maybe there's some nimble execution opportunities to do that, but it's going to require you actively managing this position. This isn't the type of thing that you can just say, okay, I'm going to strangle swap Apple earnings and can't wait to see what happens at expiration. That the way you make money on that trade is through pretty active management of that.
Yeah.
And presenting those opportunities before, your risks materialize.
Yeah. And that's a great point, by the way. I think, and I know some of the retail folks who are, maybe they consider themselves a little bit more intermediate on the scale of understanding. They're going to ask the question, well, thank you for that. And it's great advice, but when do I adjust, right? When do I do this? So, my example with Tesla, now all of a sudden I almost have 50 cents in this thing. Do I take something off now? And is that the end of it? I'm winning, right now. Do I take it off? Or is the better answer. I got 100 of these things on. Do I take off 25 of them? Right. And it's, I don't know if I have the right answer there. It's just, it's a constant game of massaging the living daylights out of your position to squeeze the profitability out of it. Right.
Yeah.
I don't know if I have a great answer either as to when to get out and just say, Uncle, it's good.
I think the answer is you have to have a plan, and it's stock specific. Like Tesla moves, 20 points on no earnings sometimes.
Yeah.
And so you have a plan for that. But, something like UPS or even Microsoft, typically after the earnings move, it doesn't move, right? That much. So I think like once you determine what stock you're doing this on, and you got to have a plan going in.
Yeah, that's a good point. I know some of the educators in our space will say that the first thing you figure out is your exit before you even figure out your entry, right? Which is good sound advice. I like it. I'm inclined from just intuition to take some of this off. Again, the reason is that I kind of missed, and it's showing me some profitability. So I'm going to take 25% of this off. Is what I'm going to do. The other thing is now all of a sudden Tesla's kind of turned over and is negative, So I'm starting to feel maybe there's a little bit of a downside move here to my short strike. But I still like to put a little bit of money in the bank. I definitely will do that. Right.
I think partial trade management is absolutely, critical, right? Like, taking some off, cutting your losses. If you don't really know what to do and the position isn't behaving like what you're expecting, take a little bit off the table.
Yeah, absolutely. I agree with that. Inevitably, I hate to say it, but you probably, when I take stuff off, I'm always like, okay, I know this is getting better now. It's almost like a sacrifice to the option gods of sorts. I know this is stupid. I shouldn't do this. It's going to get better, but I'm doing it anyway. I'm taking some off, and I hope I'm wrong. I hope it gets better for me.
You got to pay your lunch money all the time.
Yep.
You can't be sitting there with a short gamma call vertical or something like that.
Yep.
And then at the end of the day, and have MOC blow through it and pipe you down. You got to pay your lunch money.
Now, what do you guys say to the retail person who says, what about just buying the straddle? I want to take a shot, or selling the straddle for that matter.
Oh, no.
First of all, as a retail person, you probably cannot sell the straddle in an earnings play unless you have several shekels in your account, right? I'm guessing, right? But can they structure something if they don't believe the move, where they do this gigantic short iron condor, and maybe it's a straddle and it's an iron butterfly of sorts, something like that? How do you advise on that one? I'm like, that's like me looking over the cliff with no harness on. That scares me, that one. Right.
I don't like going long straddles into earnings because
I don't like going short them either.
Either way, because as we have firmly established in this show, market makers have gotten a lot better at pricing these things. So, a lot of times those long straddles, you're going to get the decline in implied volatility. You'll get enough movement for you to just lose enough,
Yeah.
100%. So, I am not a very straddle. I don't usually do the straddles or the at the money kind of stuff. If anything, maybe like a condor, because they're going to be cheap. But
yeah, that's right. Okay.
This isn't specifically earnings related, but I recently did a study about straddles and how well priced they are. Since zero DTEs have been introduced, the 1 day straddle, if you sold that every single day, what do you think your P&L is? 675 trades to date.
That's an awesome question. Wow. What is my P&L, you said?
P&L. 675 trades.
How do I get out of it?
$1 of premium.
Do I just hold it? It expires where it expires? Is that it?
Expire 1 day, sell the straddle, like 1 day to expiration. Sell it on the close today, close tomorrow.
I'd say like you made like 2%.
I was going to say you make 4%.
You lose $67.
$67.
So that's like minus 0.001%.
So $67 in options terms. So $6,000, $6,700.
Oh, okay.
Oh, okay. So that's
So like if the straddles average
It's been
price
about
is
$4,000 a
$45,
straddle.
you trade that 675 times and you lose $67.
That's
That is
like-
how well priced straddles are.
Yeah, it's like
No way.
25 bucks a day too.
It's a dime a day. It's a 35.85 or 34.85 average price that you lose a dime on every day.
wow. That's amazing. So having said that, what should we do instead? Sell that 25 delta, baby.
Oh, I did the same study on condors. How much do you think you make or lose?
You're getting
Ooh.
killed.
That's a good one. I'll say 6% make.
No, I think it's about the same.
It's
skew-
about the
skew
same.
is
Whether
well-
you're
skew is
selling
well
the
priced.
Really?
20 delta, 15 delta, 5 delta condor, your P&L is like $50, $70, maybe 150 was the worst I saw, but pretty tight range. So not only is the at the money very well priced, the wings are incredibly well priced too. Like if you think you're trading SPX with any edge, you are wrong.
Wow. So what's the prescription to trade
Dramatic.
0 DTE then? Having said that,
Well, it's a risk management tool. I mean, the options are incredibly efficiently priced. That doesn't obviate like other use cases, but it doesn't imply any like edge to pure volatility trading.
yeah.
Mhm.
But
Yeah,
you
if you're
still
doing
like to sell
systematic
the Iron
trade,
Condor,
right.
don't you, Mark?
I do love the Iron Condor, which is actually what inspired all of this work.
And you you like to sell this 25 delta leg on the call on the put, right? And whether you're going 5 strikes down or 10 strikes is up to you relative to your capital, yada yada. So that kind of the still your favorite play?
Yeah, I mean, I like those kinds of plays, but at the end of the day, if you want to make money in something like that, it's kind of similar to your Tesla position that you
Yeah.
need to be able to actively
Manage it.
manage that.
So we're going to call that theta harvesting. Theta harvesting. You get that rake out there and you pull it in. So maybe, although you like to let it ride the whole day though, right?
No, I actually think you need a decent amount of management on these, whether
Okay.
it's stop losses or take profits or closing legs.
I gotcha. So in New York when we were together, I think you originally said that you let it ride, and I think you've changed your tune a little bit with a little research.
Yeah, absolutely.
Oh, perfect. Good to know. Okay, I feel better about that now. I mean, honestly,
About actively managing it.
yeah, I feel better about it. You know why I'm gonna say what I'm gonna say next about actively manage it? Get rid of pattern day trading.
Oh yeah.
Okay,
Because it totally prevents you from trading this and
It
actively
totally
manage.
prevents you from being
Yeah,
able to
it does.
manage your inventory. So just so you know, Mark and I wrote a little piece to FINRA in the comment period, and you can read those at what is it, FINRA.org or something like that.
Yeah,
so
fantastic. Is yours posted yet?
I think so. Yeah,
Nice.
Wow.
yeah. So yeah, and Mark wrote his first, so I copied his. So it's awesome. Perfect.
I recently, just yesterday, had another use case of similar sort of 0 DTE closing type strategy that like is limited by pattern day trading, right? That you like look at something, think it makes sense, and then it's like, nope, well, can't do that in an account less than 25K.
Right. Exactly. It's very frustrating. I hope they change that. We started with earnings and we're already at pattern day trading, so it must be time to go. So this is unbelievable. But it's a good point. Maybe I should do a whole show on that pattern day trading.
Well, if you want to trade earnings, that's actually another great use case, right? Like you have a couple earnings in a week, all of a sudden you need to get in and out of an earnings play. Like your pattern day trading is going to get flagged.
Yeah, you get nailed on it. I agree. All right, Apple tonight, boys. I'm gonna talk about next week. I'll put this trade on. I think I have it out there. I don't think I've gotten filled. Maybe I have. Hold on, I'm looking. No, nothing out there. So when I get filled, I'm just gonna make myself get filled. How's that sound? And then I will
market order,
Also known as
That's
lifting
one of
the
option
offer.
commandments.
next week I will tell you what it was. So whether we did well or did not well. Here we go. So
Oh, I can't wait to hear the ding.
yeah, I'm gonna ding it. So I gotta put it on though right now. Oh, do I have it on? Oh, I do have it on. I'm gonna put a big one on. I'm gonna do like 200.
I want to hear a ding.
Hold on. Here it goes. Ready? Gonna do it. There it is.
Hey.
I didn't get filled yet. It's just out there. $1.60 for that double calendar. All right. Keep that in mind. Well, I'll keep tabs on it. We'll see it next week. All right, guys. Have a great weekend. Good to see you. Earnings plays. They're all over the place. They only happen 4 times a year. But the big ones are right now. These are the juicy ones. All these FANG stocks or whatever they're calling them now. The big high techies that really roll. So these are always fun. I'll see you guys next week. You guys have a great weekend. Drink some good wine. I'm going to have a good birthday tonight, eating good food and having good wine. What do you
Happy
think about
birthday,
those?
Lex.
All right.
Bon anniversaire.
Oh, a little French thing. Thank you. Merci.
Mhm.
Oh. See you guys
Have a
later.
great-
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.